thinking. Right, so it's 10 o'clock. Let's get started. I'm starting with the Aussie dollar. Oh, sorry, I've got the Aussie dollar in front, but I'm actually going to start with gold because I think what gold and what commodities have been doing has been absolutely fascinating. Oh, sorry. Bear with me one moment. It really has. It's been absolutely fascinating. Gold has been, on a very sharp decline, had a very, very sharp decline on Friday, went through that 1700 level, even tested, see this red line here, that's a 200-day moving average, even tested below there, so below this 1685 level, but then that's where we found support. Mildly, we've had a mildly bullish behavior, or we've had a mild recovery, I would say, not bullish, but mild recovery in gold, and I think that's really significant because gold, other commodities, I'm going to show you oil in a minute as well, but they really have been under pressure the last couple of weeks, as other markets have also been under pressure too, but commodities really took the brunt, and there were a couple of reasons for it. Why did gold and commodities, why were they falling? Well, number one, it's kind of some people have been kind of postulating that it's because of all this uncertainty in the US, the fact that the minute that the election's over, all of a sudden the focus is going to shift to the fiscal cliff, and that is going to cause, a massive sell-off. That's been kind of one of the first things to think about. The second thing, a massive sell-off and risk, which will be good for things like the dollar, probably bad again for gold, because gold does tend to move in the opposite direction of the dollar and hasn't really proved its stripes as a safe haven of late. I think there's also fears about growth in Europe, which is weighing on this, deleveraging fears. Remember, the market is now going to go into this concerned mode of deleveraging, whereby it's not just Europe that's going to do it. Potentially, if this fiscal cliff issue isn't sorted out, then the US is going to be doing it as well. And remember, deleveraging largely means weak growth, very low inflation. That erodes one of the main pillars why gold is going to be is bought, because gold is often bought as an inflation hedge. So I've heard to death, just the same argument that gold is going to be bought because there's going to be inflation, it's going to reduce, this devaluation of fiat currency, etc., etc. Well, really, if there's a devaluation of fiat currency, if lifestyles start to plummet, people aren't going to want to be hauling around gold bars everywhere. That's kind of my view. I'm a bit more pragmatic on the gold price, I think. I'm not just being kind of sucked into this it's only going to go one way debate. Maybe I'm going to be wrong. I'm certainly going to move with price action for sure, but how my mind is figuring this out is that actually gold may be less attractive in the current environment than you'd certainly think by reading a lot of things, etc. But looking at it today, that's kind of more of the overall wider view, my broader view. But looking at it on a very short-term view, I am encouraged in the short term by the fact that we have managed to find support around the 1685 level, and that gold has been mildly bullish, and we've seen that reflected into stocks. Now, just bear with me one moment. Oh, sorry, that's not what I wanted to do at all. What I wanted to do is this. As you can see, again, we've seen this is European stock markets, the Euro stock, so it's a pan-European index. This has bounced off its 50-day moving average at just over 2,500. So again, found support there. So what we're seeing in the gold market and in other commodities, whereby they've had sharp falls but they're now finding support, that's lending support to other markets. So again, this market, you can't look at it in isolation. Usually how it works is that, treasury yields will move, that will cause the dollars to move, which will impact commodities, which will then impact stocks, and all of this is between an inflation, and it kind of all is about inflation. So what we're potentially seeing is right now a bit of a commodities maybe saying that, hey, there's a bit of a chance of having some some deflation in the market, and stocks have come off their highs, as you can see, series lower lows there, but interestingly enough, we haven't made a series of lower highs here, but we haven't made a series of lower lows, which suggests really that we're still in a bit of a triangle position. In fact, if I draw it for you, we're just consolidating in the stock markets. We're not really seeing any kind of directional move. When that will come out, we think potentially the what will drive that will be potentially the outcome of the US election, the outcome of this Greek Parliament vote. They're fundamental factors. We've also got ECB meeting and Bank of England meeting this week. But going forward, obviously, it's going to be things like, going forward, it's going to be, bigger, even bigger events than that. Like, is the US going to hit the fiscal cliff? Is there going to be a problem around that? From a technical perspective, we seem to be staying within this consolidation triangle at the moment, and that is quite positive and suggests that, yes, the market is still trading sideways. But as you see, the triangle is getting narrower and narrower. How long can we stay in that triangle? That's going to be the key thing. And I'm using this overall European index, this EUROSTOXX index. It's been a big one to watch because, as you can see, it kind of turned along with commodities back in May, so turned before the euro did. We also saw, or bottomed, sorry. We've also seen it make big moves this year, and it is so reflective of the overall US economy, Eurozone economy. What's been interesting is that the EUROSTOXX index has been able to rally today, even though we got some very weak PMI data. So markets are moving more. I think this is a bit more positioning, and the fact that markets are still in this consolidation mode. They're not willing to push things one way or the other, and we're going to have to wait. We think that eventually they will, but it may be after the ECB meeting on Thursday, so we may have another couple of days really of range trading. Obviously there could be some market reaction from the US election, but really the US election is going to be felt more in the US markets, we think. Overall though, as you can see, it is encouraging that we've managed to hold on to this support level at 2,500 and really bounce from there, because it suggests that we're not going to test below the bottom of that triangle line. So obviously we know our support and resistance now. That's what's quite useful about these triangle patterns. We know our support and resistance lines now. Because we haven't made a series of lower lows, that suggests that we're not in a downtrend, that we're just consolidating. So there is a chance that we could break up on the upside. For us to do that, we think we're going to need a very supportive ECB on Thursday. Because remember, stocks in Europe and the euro react very, very well to a reduction in credit risk in the eurozone. Now, the markets don't expect anything. We agree with consensus. We don't think there's going to be any policy changes from the ECB on Thursday. What's going to be more important then is going to be Draghi's press conference. Again, we think actually, if anything, he might be just a bit more harder on countries like Spain, who have still not applied for bailouts or etc. And so we've still not we still haven't triggered the OMT program, and without that, I don't see how we can have prolonged or sustained period of reduced credit risk in the currency block. So that's kind of a bigger concern. But it does show that potentially we could be moving sideways just for a little bit longer in the stock markets and euro-based assets until we get that ECB meeting. Obviously, it seems now like it's going to be an Obama win. If we get an Obama win, we believe that there's going to be a few things. Knee-jerk reaction may be lower stocks, purely because the Republicans and Romney in particular have kind of made noises to say that the tax code will be more stock-friendly and corporate-friendly, etc., etc. Obama hasn't followed suit. However, what Obama has done is supported QE and supported the Fed. So potentially his victory could be negative for the dollar, and positive for QE, which could eventually feed into higher stock markets in the US after we get a knee-jerk reaction lower. Now let's take a quick look at the the S&P 500. See what that's going. Very, very similar pattern here, as you can see. Yes, we've fallen, but we've really bottomed out, and we're really trading in a very narrow range. 1400 on the downside remains very good support. As you can see, multiple tests below there now, and we've continued to hold it. We haven't really dipped below it for any significant period of time, but 1434 really capping the upside there, which is your 50-day moving average. Moving sideways for sure, but still at a high level. So again, it's all going to be very dependent on the outcome of the election. We think you don't often get periods whereby you move sideways for long periods of time. Not in these very, very tight ranges. Yes, we moved sideways between kind of 1350 and maybe 1450. Yes, we've moved sideways potentially we've had milder rallies, but overall all year we've actually been in an uptrend. So that's a very, very powerful uptrend there. We're not yet showing signs that we're going to decline. I believe if we get below the 200-day moving average in the next days or in the aftermath of this US election, then that could really be a sign that we're going to decline further, potentially to 1250. I just also want to go just back a little bit further because some people do seem to forget this. Oh, not 12, sorry, my fault. Let's get this up. This period here, this is a 2-year chart nearly, or 18-month chart. This period here, which was August, September last year, was when we had that debt market standoff in the US over the debt ceiling. Then the S&P 500 was back at 1100. So we are a long way from that right now, kind of 300-ish pips away. So there could be a long way on the downside if we still get that tussle. So if we were to get a split government, maybe an Obama win in the White House, and for the Republicans to keep hold of the House, they're going to be the key things to watch out for. If essentially we get that, the worst outcome we think, which could really see stocks tank, would be a tie, so a tie of electoral college votes, because that's the system that the US use, is this electoral college vote system. If you get a tie there, which means that neither candidate has got enough of the electoral votes, which is 270. Right now, Obama's more on course to get them, but again, we don't know necessarily if he will. But if neither candidate gets 270 and there's a tie, that could be the worst outcome, because that could just mean more and more tussling when we're running out of time because of this fiscal cliff that we're fast approaching. So very, very, very definitely worth looking out for, and there could be huge repercussions, especially in US stock markets, on the back of what goes on in the US. Obviously, what goes on in the US also has a big impact on what goes on elsewhere. We all know that, so we would certainly kind of wait. We'd certainly, expect overall weakness if we get that tie tomorrow. Okay, the other thing to look at that I wanted to show you guys is the Aussie. Now, just bear with me a moment. I want to swap charts. Now, the Aussie, there's a couple of things that I just want to tell you about price action today. Price action today has been in the FX market, price action has been very much the safe havens rallying, but so have commodity currencies like the Aussie. The Aussie has been the strongest performer today in the G10 FX world, and the main reason why is because the RBA kept interest rates on hold early this morning when they announced interest rates. So they kind of surprised the market, even though expectations had been pared back for a cut in interest rates. Inflation was a concern for them. Also, there had been some stabilization in China and in the external environment, which again gave them less impetus to hike interest rates. So what we've seen instead is a sharp kind of reversal higher in the Aussie, as you can see there. This is the daily chart. I'm going to go back just to the 60-minute. Looking fairly overbought there as well. After that sharp move higher, as you can see, that's all post the RBA. And we managed to break out of our near-term range, get above that 104 level. But really, to get to, let's just go back quickly to our daily chart. To get back, to have a chance of testing our most recent highs, we think a break above 104.50, a very, very bullish development for this pair. That would take us to kind of the 105 zone, which would then very much open the way to the top of that range at 106. But obviously we know that the Aussie is a high beta currency. We know that it's quite unusual for the Aussie to rally alongside safe havens. However, there is something to keep an eye on here. Obviously, interest rate differentials is one of the things that has been moving the markets of late, and you can see that. Let's take a look just at Euro Aussie. This is Euro Aussie. It's really come off over the past month and a bit, largely because, again, as we said, we think this is kind of a very telling indication of what the market's thinking. So today, for example, we're seeing safe havens rally and commodity currencies, like including the Aussie, the CAD, and the Kiwi. Obviously, the Aussie being the strongest performer out of them. But the main reason why we're seeing that is because we're seeing, investors want safe havens in this environment. A lot of uncertainty this week. US US elections, also that Greek Parliament Parliament vote on the 2013 budget tomorrow. So we're seeing an awful lot of uncertainty. We're also seeing, and that's attracting flows into safe havens. On the other side, we're seeing investors still want yield, and that's why things like the Aussie are doing very well against things like the euro, where yield is very, very low. Things like it's doing better than the dollar, or doing better than the dollar today. It's rising versus the dollar today because of that yield differential. Let's look at sterling Aussie as well. You're seeing something very similar here. You're seeing this sharp decline because, again, investors want yield. They're not getting it anywhere else. They're not going to get it from the UK or the Europe anytime soon. And that really is, making the Aussie a slightly more attractive option. The other thing that I would point out as well is let's look at Aussie yen. Now, Aussie yen has been kind of one of our most or a very good risk trade. It's been trading sideways, but as you can see, even over the last couple of days, over the last kind of day, let me just draw this line now, okay? What we've really seen is us break out the top of this range. That's quite a bullish development. Aussie yen usually is quite a bullish development for the overall market. So it'll be interesting to see if Aussie yen is rallying today. Yes, partly it's because of the RBA, but often this pair also doesn't just reflect internal issues, but also internal issues, but also external issues, like the overall risk environment. So if we're rallying today in Aussie yen, it could be on the back of expectations of Obama victory and things being kind of the status quo remaining the same. So that's kind of another interesting thing to consider when you come in tomorrow, or if you're staying up very, very late for the US election results. On the one which are due out at 4 a.m. London time, by the way, 11 o'clock Eastern is when the first results should be known. If we do get an Obama victory in the White House, and he wins by quite a margin, that could be deemed as risk positive. And the reason why is that people may forget things like, oh, well, the tax policy, this, that, and the other. They may think, we just want status quo. We just want the same thing. We've now got over that chance of... We've now got over that chance of a change. We've got rid of that uncertainty. The markets may just kind of breathe a sigh of relief before they start worrying about the Greek poll and also obviously the fiscal cliff. But that's just a key thing. Also, if we get Obama winning with a very large margin, we may see that he may then have a bigger hand to really play about negotiating something around this fiscal cliff. Now, I've had a couple of interesting things from TN, 80% chance for Obama to win. I mean, it does seem like that. Obviously, the US media, the UK media, for that matter, as well, very much playing up this tie thing, getting it together. I think the trouble is because of the way that the US election system works. I would say that Obama probably has about a 75% chance of winning at this stage because of that electoral college system of voting. Basically, he's now in the lead with electoral college votes, which means that he only needs to win 25% of the votes up for grabs in the swing states, whereas Romney has to win 75% roughly, and that's going to be a really, really hard thing for him to do and pull out of the hat. Obviously, right now, a Romney victory would be the biggest surprise, and that could have the biggest market impact. An Obama victory, I think the markets seem a bit prepped for that, and I'm just wondering, just looking at the FX and whether or not you can kind of look at it through kind of risk sentiment in the FX market. If we're seeing this kind of mildly bullish tone, based on expectation that the status quo will be remained and will remain in place, and as we all know, the status quo, markets like status quo, they don't like change too much, they don't like uncertainty. Okay, the other thing I want to show you as well, there's a few other things I want to show you. Let's take a look at euro. Euro dollar's been had an interesting few days. Remember, it ended the week very, very in very kind of a bearish or bad shape, really. It went through its 200-day moving average, as you can see here. I'm also going to bring up the Ichimoku cloud. Oh, not this one. I'm also going to bring up the cloud. Let's take it. We fell through the daily Ichimoku cloud, through 128.75. I mean, all of that really is that was very bearish, especially that fall through kind of 128.40 as well. Today we've been trading in a very, very tight range between kind of 127. Oh, let me just find that out. Which way? Today really we've been trading between kind of 128. I mean, very, very tight, 127.65-ish and 128, well, really 128.20. Let's just go back to this cloud because, there's a few things to kind of point out. Obviously, we've got an ECB meeting, we've got the Greek vote. There's a lot there that could fundamentally weaken the euro going forward. However, we've also got this outcome of the, of the US elections. Again, an Obama victory could, weigh on the dollar a bit because it would support more QE, and we could see the euro kind of, rally, maybe stage a mini rally in the next couple of days. But we think if that does that, it's still going to be a sell on any strength. So a move towards 128.50 sell could potentially attract some selling interest, especially as we lead up to the ECB meeting with them not really doing anything to reduce credit risk any further than they've already done. In that sense, we could actually see the euro dollar, we think a very bearish development for this cross would be a break below 127.40, which would then open the way to the base of this Ichimoku cloud here, which comes in around 126.10. Remember, the way that Ichimokus work is that the minute you get below the cloud, you're no longer in a technical uptrend. So right now, we have still got, the cloud is still kind of moving higher. It's not flattening in any way, which suggests that there's still the potential to trend. But we, right now we're technically not in a trend. If we continue to decline, then we may see, a test of that 126 mark, and below there is a technical downtrend. It doesn't look like we're kind of moving sideways for any particular period of time. It looks like the markets are willing to take a direction. Yes, we're in a very narrow range at the moment. And as we said, the same with kind of US stock markets. It's not often that it lasts, whereby you're in a really, really, really tight range. So watch out for that. We could potentially break one way or the other. And that is certainly worth watching out for. But again, on balance, we think fundamental picture looking very, very weak for euro at the moment. And it's going to be a sell on any rallies. Someone's just asked someone's just said, someone's just looking at the pound. Let's take a quick look at the pound. I think you've got your numbers mixed up just a smidge. Basically, let's take a look at the pound over the last 2 days since the beginning of this week. So someone has just said here that they put a long on at 156.65. No, that's not cable that you're talking about there. So I think maybe, I'm not 100% sure, but you didn't, you may have put orders out to buy at that level, but they wouldn't have been filled, basically. What we've seen with the pound, as you can see, had quite a sharp decline with overall kind of risk sentiment yesterday. We also had that very weak PMI data out of the UK. We had more weak data today. So basically what this shows is that, over the last few weeks, the momentum in the UK economy from the third quarter has really started to wane slightly. We haven't continued to see that strong growth in the UK economy as we saw in the first quarter. So what we've seen instead is us kind of moving sideways here between 159.60 on the downside, 159.90 on the upside. Basically that 160 level now is tip-top near-term resistance, very, very strong level of resistance. Again, going back to, the question that we just had about trading, if you don't want to stare at your screens, I mean, the good thing to do is maybe put on your trade and you always use a stop loss, and use a stop loss that is within your own risk, your own risk tolerance, and you will know that. Also, if you're not really used to trading, maybe the best thing to do to trade strategies to see how the market works, open up a demo account, take a look at paper trading for a little bit, until you're just a bit more comfortable. Maybe you test out some strategies of your own and then move on. But just going back to cable, as you can see, very, very tight range, looking very similar now to the same as the cable chart. Now let's just take a look here as well at cable. One moment. As you can see, yeah, I mean, you know, very, very tight range. Yes, we've fallen, but as you can see, we haven't really made that series of lower lows, so very consolidation mode, and that's what we've been. And this is just the hourly chart, so consolidation mode in the short term. In the longer term, though, I mean, you know, yes, we've come off, as you can see here, but we are holding good support here now, 159.50, major support level. Again, if we fall below there, then that could open the way for a decline further towards 158.50. But a lot of it is also going to be dependent. We have the Bank of England this week as well on Thursday. Now, there's a good chance that the market doesn't expect them to add more QE. Remember, it wasn't that long ago that the market was looking for more QE, because remember, their last round of QE will expire this month. But there's a good chance now that they won't do that. Basically, strong growth. You know, strong growth in the third quarter may put them off. However, what is kind of the big concern is that we've had some weak data, which puts it more back on a knife edge. We know that the governor of the Bank of England is very, very dovish. He wants to do more QE, but then we've heard from other people who are much more sitting on the fence. We think on balance they won't do it. However, there is a good chance actually that what they may choose to do instead is to, you know, we think it's going to come down to the wire. They may point more to a decision in December and push it out till then. But you know, this weak economic data makes more QE down the line likely. Maybe not Thursday though. The other thing that we would point out too is that you know, obviously when you get Bank of England decision and they don't make any changes, they don't release a statement with that. So that's another key thing to point out to you. Okay, the last thing I want to show you here is dollar yen. And someone's just asked me to go through Ichimoku clouds again, which I will do in 1 moment. So just bear with me 1 minute. As you can see, dollar yen, I mean, let's look at the hourly chart. It's pulled back from that 80-60 level. It's found very good support at 80. So again, it's kind of range trading. It's treading into this, or kind of range trading into these US elections. The US elections are going to be really pivotal for a pair like dollar yen, because they move, could potentially move, have a material impact on Treasury yields. And what we've seen with Treasury yields, let me just bring them up. As you can see here, but Treasury yields are backed away from that 200-day moving average. It wasn't that long ago that we were looking at it and potentially seeing us above there and yields kind of carrying on. Well, since then, the market's been gripped by a bit of risk aversion. They've been worried about the outcome of the election, the fiscal cliff, the Greek vote, and that's going to keep Treasuries well bid, yields lower. So again, watch what yields are doing if you're going to trade dollar yen. And I just want to show you Ichimoku cloud chart as well quickly. I want to show you the weekly Ichimoku cloud, and then I'll go through how these clouds work. But basically, what we're seeing here, as you can see, the cloud is kind of flattened, which suggests that we're not really in much of a longer-term trend at the moment. So, you know, we really need to get above the top of this cloud, which it comes in at 80.85. Of the top of the weekly Ichimoku cloud above there suggests a technical uptrend, but a technical uptrend with real oomph. It was just a kind of a new paradigm for dollar yen. So how do these Ichimoku clouds work? They're very, very simple. Basically, just looking at it from a very basic point, above the cloud, anything above the cloud is an uptrend, technical uptrend. Anything below the cloud, like here, technical downtrend. The top of the cloud, this top here, very, very key resistance level or support level if you're above the cloud. Bottom of the cloud is key support or resistance, again, depending on where you are in the cloud. So they act as key support and resistance levels. When the cloud narrows, it suggests there isn't necessarily a trend. So it suggests at the moment, the long-term trend in the yen is still kind of sideways, even though we've seen some strength. We see sustained strength before we can even have, you know, even entertain ideas of kind of going back to those February highs around the 84 mark. So that's the key thing here. So I hope that was helpful. Someone's just mentioned that they came to the World Money Show on Saturday, and I was there. I was indeed. Thank you for coming, and thank you very much for listening to me then. Thank you also for joining this webinar today. I'm going to be back tomorrow. I'm happy to take one question. I know it's 10:30, but I didn't ask any questions. I tried to answer a few as they came through, but if anyone has one quick question they want me to take a quick look at, then please let me know. Someone's just asked what the fiscal cliff is. Well, that's when the US that's when the US will see a number of tax cuts and spending programs expire. Basically, if they expire, then taxes will rise, government spending will fall. It has the potential to throw the US into a recession next year. So that's a quick potted history of what the fiscal cliff is. Someone's just asked me to look at Aussie dollar. I did actually look at it there. Basically, above 104.50 could see us to 105. So and then below there, we seem to have very, very good support, 103.20. Also, that 104 level is going to be a massive support level in Aussie dollar. Someone's just said, if Obama wins, could that be good for euro dollar? I think we think that really, if Obama wins, essentially that could be quite good for euro dollar because it could ease pressure on the dollar for US dollar for a couple of reasons. Number one, it would eliminate uncertainty, which could mean investors move away a little bit from safe havens. And number two, Obama supports the Fed and supports QE, so there's less of a chance that QE will end anytime soon under an Obama administration. That's not necessarily the same case in Romney, which could then, of course, be dollar positive. Okay, everyone, thank you so much for listening. Again, thank you for joining today. And if you were at the World Money Show, like I can see some of you were, and thanks for popping along to that. And it was good to meet some of you there as well. So please do join us next week. Remember, tomorrow we have our own Forex.com webinar. That's at 10 o'clock, same time. You can sign up for that on our website. Okay, everyone, thanks very much, and good luck trading today.